Hi, everyone. My name is Matt Brown, and welcome to the Direct Private Investment Show. With me is Bruce Roberts, the CEO of Carofin. So, Bruce, welcome to the show.
Thank you, Matt.
So, Bruce, you've evaluated thousands of deals over the last 28
Right.
years or so. What makes a good deal?
Yeah. Well, let me preface this by saying it's I always find it a little bit humorous when I talk to people who are in deal flow, making private investments, and it's with amazing consistency. The deals that ultimately have worked, well, those are obviously always good deals, like it was obvious, and it's not obvious. I would tell you most of the deals we've had that have reached a liquidity event have been successful. I know their history from beginning to end, and I can tell you they were hanging on the edge at some point or at multiple points. But what I think you can do going into a transaction before you know the outcome, but of course you don't, is there are several things that kind of make that up. It's sort of an axiom of venture capital or any business that it's about the people. There are incredible stories out there. I think Carolco, I'm saying the name right, this is many years ago, started off as a video game. And I guess the video game wasn't really working, and they eventually made a small fortune with Cabbage Patch dolls, right? So kind of one of the classic pivots in the world of technology, I guess. But management is enormous. It's going to be the people that drive the business. And when you look at the studies there, the one consistent factor is perseverance. But you start with the people, and that's probably more of an art than a science. I've made good calls and I've made bad calls, but I would say you should feel comfortable with management. You should feel like they're, look them in the eye, they're being transparent, they're being honest with you. And importantly, you need to make sure the incentives are right with both management, founder/management, and yourself. Venture companies need to have an equity culture, not a cash culture. Meaning, if people are taking large salaries and large bonuses, well, they're just not at they're not at the same risk that your money is, right? So, if everybody's upside comes to the same event and on a scale that's fair and proportionate, that's a pretty good start. And if you find that your management going in is not willing to provide you, have that level of skin in the game, if you will, well, it's probably not a good fit.
So over and above people, which I totally understand, people from my experience are oftentimes a bit like sharks, unpredictable.
Right.
Over and above people, let's say you nailed that and you get a good sense and chemistry with this management team. What are other factors that go into identifying a good deal?
Yeah, equally high on my list is customers, and by extension, sales. If another human being has parted with their money to buy your product or service, and particularly if you've had repeat, you can see a pattern there, then, you as an investor going in, even if the company has negative cash flow, it's a venture stage business, you going in, that, okay, the company's delivering the goods, the people are buying the product, more people are buying the product, and it may be a far step from what is needed for the company to be cash flow positive, but you've got probably the most important level of validation in terms of what they're about, which is some customer out there, be it a retail customer, an individual, or a business customer, has a need or a want, and this company is satisfying that, and for that customer is willing to pay them for it. I find that's incredibly validating. Everything else is an incredible leap of faith in terms of, will they ever get to that point?
Absolutely. One of the key things talking to you, Bruce, is that is around this challenge of financial management when it comes to issuers, because in many cases, I would include myself in this bucket, we're not CFOs. We don't have financial management skills to the level of being able to predict the future or forecast the future in such a way that it's accurate. So where does the role of financial management play out, or how does it play out in the context of identifying a good deal?
Yeah. Well, I think when you first begin to interface with management, a red flag would be if you ask someone questions about, well, tell me about your product and the financial margins that are associated with your project. What's the gross margin? Selling price less cost of goods sales get you the gross margin. If you see them deflect that and say, well, that's really not my thing. That's, my accountant does that, or, someone that's not really a principal to the deal. To me, that's a red flag. I would say that there's kind of two levels. On the one hand, there needs to be an understanding of what's the financial game we're playing here, because if you're an equity investor, at the end of the day, what you're going to buy is a share at a price, or if it's an LLC, a unit at a price. And what you're going to get back is that share sold at a higher price. It's not really changed, whether it's a public security or a private security. But, what had the appreciation of that price is going to be a function of equity value growth by the nature of the business doing what it's doing, but it's going to be held back by more capital being raised, that dilutive event. So there's that whole level of how do we take our equity value up to the point that I, as a venture investor, going to benefit. A different level of finance, though, is financial management, where do they have the proper systems in place? QuickBooks is very popular with a lot of companies, and that's perfectly adequate at the early stages of a business. But depending on the nature of the business, you'll probably outgrow that relatively quickly, particularly if you've got more involved cost of production, a more complicated, as a business becomes more complicated, you need a more robust accounting package. I would tell you that in my experience, young companies almost all underinvest in both having that infrastructure in place and having the people in place so that the data, the numbers you're getting on the business are accurate. So for me, what's part of a good deal is I'm not flying blind. I've actually got a financial infrastructure that's giving me an accurate representation of what's happening with the business on an ongoing basis. Frankly, if they don't have it, it doesn't mean it necessarily isn't a company you should pursue, in our case, because we actually provide that. We now have staff, and we don't see it, we'll impose it, frankly. And that takes us into even deeper ongoing involvement with the company. But at least we know, as they're running out of business, if it's a venture stage company, it will run out of money, not out of business, but out of money. And so you can be ahead of that liquidity curve. So
in this space, and especially in the startup space, the venture space, Bruce, everyone loves to talk about scale. And do you have a problem that's worth $1 billion or more, et cetera, et cetera, et cetera. I find scale, from my experience, to be a bit of a double-edged sword as a founder. Sometimes as a management, we touched on management, as a management team or as a founder, if you're not able to cope with scale, you can be replaced by your board or your investment team. And so I'm curious to understand from your perspective, when we say a good deal in private placements, is scale the bridge?
Well, okay, first of all, different business models bring with them different inherent issues. So, for example, a venture deal is normally heavily driven. The value in that venture deal is often driven by the intellectual property that underpins that deal. And that could be an algorithm, code. It could be, if it's a branded product, it could be some kind of, branding and trademark certainly will go with that. And maybe that company, you have to have a consciousness of how far do we really want to take this before we're driving to a liquidity event. So if you don't have, I can tell you, for example, in software, particularly enterprise software, SaaS business models, you need to be thinking at a very early stage. Even if you're looking for an earlier exit, you need to be building a solution that is scalable. It's robust from a technology standpoint. And so, myself, because what's going to happen is you might have small customers. Again, I'm sort of in a SaaS environment or an enterprise level software environment. You might have some early customers, and they might in fact get satisfaction from the application. But at some point, as it scales, you're going to hit a wall. And to the extent you did manage to secure ever larger customers with more and more users for whatever that application is, somewhere there you're going to hit a wall. And, we have a saying in our business, you get one chance to make a first impression. And so, you've blown that first impression if all of a sudden you couldn't scale with it. So, I know I'm kind of talking around it. On the one hand, I'm not a big fan of a company that on a going in basis believes it needs to be the next Microsoft. I mean, that's a freak of nature. You have a genius in Bill Gates from a business standpoint who could continually evolve with a growing business. And he brought in very capable people along the way who could backfill what might not have been his strongest suit, maybe on operations, as opposed to, his vision. But you certainly have to have an eye towards scale, because if you don't, you're setting yourself up for failure. So it just needs to be a part of the early on. So I'm kind of talking to both sides of my mouth. On the one hand, do they have to achieve the scale themselves? Not necessarily. Probably not, actually. Do they have the potential to scale? Yes. And I would say one other thing about scale, in recent years, the knee-jerk for, say, a product manufacturer actually making something and delivering has been outsourcing, right? I mean, you could walk through almost any retail institution, made in China, made in China, made in China. As we're talking here in relatively early in 2023, supply chains have been dramatically disrupted, and it's not just COVID, it's now sovereign risk, right? And you're seeing it across many, many different channels. So we're actually going into a period where, you need to look at that supply chain because it's pretty darn hard to make something. And America and its infrastructure to do that is not what it was 40 years ago.
Yeah.
And that's, so, yeah, it's complicated. But obviously, if your upside is limited because you can't scale, then that's something you need to look for.
But as an investor, you don't need to be the next Microsoft to find a great private placement opportunity.
Not at all. Yeah, and when we bring a deal, we're looking at IRR. What's the projected rate of return of a reasonable exit? And for individual investors who on balance, let's say in our world, are investing on the order of about $100,000 per transaction, they want to take $100,000 and they want to turn it into $500,000. Well, a five bagger, if you will. You can take a company let's put it this way. It's a lot easier to take a company with a $10 million valuation and turn it into a $100 million valuation than it is to take a $100 million valuation and turn it into a $1 billion valuation. Both of them give you a 10x, right? But, barring any dilution when it might happen in between. So we're quite happy to do more modest sized transactions that we think have a reasonably high probability of reaching success, even if the exit is, on the scheme of things, more modest. Our investors are benefiting because, as far as they care about, their money's grown nicely.
Yeah, couldn't agree with you more. Bruce, is there anything else that goes into a good deal?
There is one other thing. It's the great intangible in this. I call it a Craig. A Craig. Yeah, Craig happens to be a human being that is in our company. He's our chief operating officer, and he allows me to be the banker, the deal guy, the visionary, if you will. And I happen to operate in a heavily regulated world. I operate in a world where pennies matter in the sense of we're keeping accounting for our clients to know how these deals performed. I mean, the minutia of our business is not to be believed. Craig is a very detail-oriented person who, in our case, he likes to solve problems with digital solutions. So he's always making us more efficient. I find when I look at a company and I see an entrepreneur and a founder, one of the challenges of a small business is to grow to a level where you can actually do what you were created to do in the first place. There's so many things pulling at you. It could be human relations. It could be tax. It could be regulatory. There's so many things that you got to get above as a scale so that you can actually then have your resources deployed towards the value proposition we're chasing in the first place. I guess it's true of any business, right? Now, you can outsource things. Every time you outsource, you're taking the risk that outsourced party performs for you because they're not just working for you. They're working for multiple parties, right? But in our case, we have a Craig, and Craig is unbelievable in his ability to cover the waterfront of the things that otherwise could distract us from our primary mission and being able to be successful in that mission. So, yeah, you need a Craig.
Well, the world needs more Craig.
Yes, it does.
Thank you, everyone, for tuning in. Bruce, it's been a privilege chatting to you, and we will see you all again soon.
Great. Thank you.